Hi guys and welcome. If you have $80,000 in student debt at 6% interest for 10 years, you're going to pay a total interest of $26,000 for that loan. By cutting the interest rate even a little by refinancing, you can dramatically decrease that extra money that you're paying. Even changing out your payment options can make a huge difference in the way your student loans get paid off. It makes sense when you consider the fact that lower interest means a lower debt overall. On this video, we're going to understand how does interest affect the payments you make and review 6 different ways to lower the rate. Let's start. Of course, not everyone knows how to go about refinancing their loans. The key is to make sure that you take a closer look at each of these different ways to reduce your interest rate. How does interest affect the payments you make? When it comes to your interest rate, it's generally assessed annually. But we're going to take a look at that for a $100,000 loan over 10 years. The principal continues to decrease as you get closer and closer to the payoff date. This means you'll pay less and less interest over time. What you can see from the chart above, however, is that paying less interest is going to mean you pay a whole lot less on the loan over time. That's going to help you save money, and it's going to make sure the debt is gone a whole lot faster. 1. Building up your credit. Your credit score makes a huge difference in your interest rate. With high credit, you can often get the lowest rate. The reason behind this is that higher credit scores show a financial institution that you are a better borrower and that you're more likely to make the payments. You're not as much of a risk as someone who has a low credit score. The magic number seems to be right around 680. At that point, you're going to get a decent rate when you refinance. But you'll do even better the higher your score is. Make sure you're also looking at the requirements for the specific institution. Some might have higher requirements than others. If you're looking to increase your credit score, here's where you should start. Make your payments on time. Late payments influence your credit score the most. Keep your card balances low. High credit balances make you look like more of a risk. Pay off debts. Moving debts too much makes it look like you're hiding things. Don't close your cards. Closing cards increases your debt to credit ratio. Don't open new cards. If you don't need the card for anything, you could do more harm than good. 2. Stick to automatic payments. Often lenders will offer to give you a lower payment if you agree to let them take the money out of your account automatically. With federal loans, you could save up to 0.25% just for letting them make automatic withdrawals. And it can be for the minimum payment on your loan, so you don't have to worry about making larger payments. For those who don't think 0.25% is a lot, you should take a look at the math. $80,000 of student loan debt at 5.75% versus 6% can actually save you $1,500. That's going to mean a lot when it comes to spending that money on something else, right? The key reason that you get this kind of benefit is that the lender is going to have less risk involved. Since you are making your payments automatically, they don't have to worry about you getting behind or missing a payment. But it's also a great option for you because it's more convenient. What's really great is that automatic payments are simple to start up. You just need to make sure that there's always enough money in your bank account to make the actual payments. If there's not, then you end up with fines and fees that make it even more expensive for you to pay your debt. If you call the loan servicer, you can generally sign up for your automatic payments quickly and easily. All you need is the bank information and loan information to do it. What's even better is you usually get to choose what date you want the payments to be withdrawn. This makes it easier for you to make sure the money is in the account and ready to go when they want to pull it. 3. Choose the right lender. If you start out with the right lender, you can generally get lower student loan rates as well. That means you're going to need to look at your options, and you're going to have to make sure your student loan fits what your actual needs are. The lender you choose is the one that gets to set the rate, after all. So if you're taking out loans and you get a subsidized loan, you're going to have the lowest interest. These loans don't charge you interest while you're still in school. Unsubsidized loans will generally be the next best option, and plus loans are the lowest, before private loans. When you're looking at those private loans, you want to make sure you're even more careful about choosing the right one. Each lender is going to have different rules and requirements, and they're also going to have different interest rates. Keep in mind that just because one rate is advertised doesn't mean that's the rate you're going to get. If you shop around, you might find a number of great options, but you also might find that the best choices are right where you normally do your banking. Just keep in mind all of the fees and costs associated with those loans before you jump in. 4. Pay them back fast. You'll pay a whole lot less in interest the faster you pay off your student loans as well. If you can pay them off before your loan technically ends, you're going to end up paying a whole lot less overall. You don't get a reduction in your interest rate for this, but because you pay interest over a shorter period, that means there's less interest that's able to add up over time. For some, this can be a little bit difficult because you don't have a lot of extra money, but at the same time, it can make a huge difference. Even a small amount extra can help you with your loans. $100 extra each month can make a dramatic difference, and if you can start to build that up over time, you'll cut down your loan payments even more. Some people really want to pay back their loans, so they actually take on an additional job and put that toward their student loans. The way it ends up is that a $100,000 loan with 6% interest for 15 years costs you $51,894 in interest. If you pay it off sooner, you'll save a whole lot. 5. Get a cosigner. If you get a federal loan, you're generally not going to need someone to help you out as your cosigner. On the other hand, with a private loan, you might need to go this route. Keep in mind that this person is going to be putting their financial lives on the line for you, and that's a risk not everyone wants to take. Someone who agrees to sign up as a cosigner is likely going to be a close relative or a parent. On the other hand, some people are willing to sign for a friend or as a mentor. Whoever it is, you want to make sure that you have a close relationship with them and that they're going to be willing to take on the responsibilities if you don't end up making the payments on time. Keep in mind that there could be a number of different requirements out there about cosigners. Each lender has the ability to set their own rules and restrictions, so if you're planning to use a cosigner, you need to know those things. Also, make sure you appreciate the risk that they're taking on your behalf. 6. Refinance. For those who do have private loans, you won't be able to get into any kind of alternative payment plans. The only way that you can change things with your loans is to go through the consolidation process and refinancing. The way this one works is that you actually apply for an entirely new loan that rolls everything up into one. This gives you entirely new terms, new interest rate, new monthly payments, and more. You also get to talk with your lender about extending your repayment period and or lowering the interest rate that you pay. This can help you to lower your overall monthly payments. For those with $40,000 in student loans and 6% interest, you would likely pay a total of $444 a month over a 10-year payment period. You'd end up with a total of over $13,000 in total interest charges. Just lowering your interest rate to 4.5% means that your payment over 12 years would be $360. You get a longer term and you would pay less than $12,000 in interest. That means you end up saving almost $1,500, as well as increasing your time available to pay and the payments that you're making. What's even better is your credit doesn't need to be perfect. You could get refinancing even with less than ideal credit, and even if you think that your interest rate isn't that bad. You'll want to talk with your financial services provider to find out for sure. Just make sure that you look at all of your options before you decide to refinance. You could end up with some really big benefits, but you'll want to know what your options really are and what you're choosing between. That's it for now. On our website, you can find more posts and podcasts, as well as calculators and other financial tools. Do you have more ways to reduce rates? We would love to know your thoughts, so feel free to share them on the comments below. I hope you enjoyed it. Don't forget to subscribe to our podcast channel on YouTube.